Thank you, Ms. Bandia, for this very insightful keynote and indeed a lot of food for thought for the attendees and today speakers and panelists. And I really like the way you've structured your presentation with the data, the level of adaptation and innovation of the market, the deepening of the capital market, the trust and transparency, but also a level of inclusion, and also like the hygiene part and especially around the LIBOR transition, which has been quite close to my heart as well over the past year. And it's probably one thing that I would remember is that when you're saying the sun never sets on the India government bond market, which I think it's a great way of starting the day. So thank you again for your time, and we're definitely looking forward to keeping engaging with you and your colleagues at RBI to support the embedment of the India capital market. Could it be for India, but or for the outside investors? So the next panel I'm very pleased that I will have a pleasure to moderate the next panel that will cover the development of the debt market and the much anticipated bond index inclusion. In March 2021, FTSE Russell put India government bonds on positive watch for inclusion in the emerging market bond index. It was confirmed to be maintained on the watch list in September for a next review in March 2022. There were encouraging remarks recently from the Minister of Finance as we are heading towards the 2022 budget discussions. And of course, that would be absolutely great for India, but we're not there yet. So what is left to be done to meet the criteria set by the index provider? What are the investor expectations and appetite? And once the government bonds get included in the index, how can that be leveraged? To discuss these points, we have a great panel of experts for you today. We have Alastair Gilmour, Head of Fixed Income Trading with Capital Group. Welcome, Alastair. We have Badri Nivas, Managing Director and Head of Markets and Security Services for South Asia at Citi. Welcome, Badri. So we have Tim Batho, Chief Strategist, Index Policy for Asia Pacific at FTSE Russell. Welcome, Tim. And we have Balaji, Balasubramanian, Partner, Tax and Regulatory Services at PwC. Bala, good morning and welcome. So let's start by setting the scene. And turning over to you, Badri. Clearly, the index inclusion is something that is very much anticipated, but why is that important for India?
Thanks, Philip. And let me start by first thanking Ms. Bandia from RBI for such a wonderful, speech and giving the gist of all the regulatory progress. Really appreciate. Coming to your question, obviously our growth aspirations need significant amount of investments and spending, especially on infrastructure. And if you look at it, there's an asymmetric participation required from public funds in making these investments. And at the same time, we also need public financing into various social schemes, healthcare, education, agriculture, etc. So financing all the required growth through domestic savings obviously has its limitations. If you look at this, if you look at the spread between domestic savings of the economy and the public debt as a percentage of GDP, it started widening, and this widening could accelerate if the spends have to be more front-loaded. So simply, there's a big need for liquidity to be available for private sector credits, which will bring down the cost in general. Second, if you look at it for many years now, due to successive QE programs by global central bank, there's a large pool of liquidity looking for investment destination, right? And it's important for India to tap into this liquidity pool. The Indian equity markets have benefited, over the years with a reasonable weight in the MCSI index. And if we can get the similar benefits on the public side debt too, it'll be wonderful. Third, I think the index inclusion will also remove likely some of the policy shackles and unrestrain them. What I mean is, for example, when the government makes its budgets, fiscal planning, they would go with a strong sense of certainty on the ability to manage the borrowing program, given the pool of global flows that will come in. And lower interest costs for the government could also help in the faster fiscal consolidation. And on the other hand, if you look at it for the central bank from a policy perspective, it would reduce the burden on them to overmanage the yield curve, in a sense, freeing up the policy focus on FX, banking liquidity, and providing more flexibility in the monetary policy setting. Lastly, I would say the index inclusion will also in some ways act as a guardrails for prudent policy making by the government and other policy makers, right? Because you will get some early feedback from global investors in case of any perceived or otherwise macro prudential missteps, right? And this could be of significant benefit to domestic investors and markets in general, bringing in greater transparency and accountability. So all in all, I think there is an immense array of benefits that would come for the country through this index inclusion.
Thank you, Badri. And maybe over to you, Tim. I mean, from your perspective, of course, you've seen the index inclusion across many jurisdictions. And do you see that? How does that compare with other? Do you see that similar in India, or is that different, or is that overlapping?
Thank you, Philip, and thank you for the opportunity to join this panel. I think it's very difficult to compare jurisdictions. I mean, obviously there are some commonalities from jurisdiction to jurisdiction. Typically they are based on a domestic audience historically, and they're in the process of opening up to international investment. I mean, the reasons that have been explained are relatively common, but the path to get there is very unique. Different concerns from regulators, different appetite for the international investment all play into this. And one thing we have learned is every market will find its own unique path, and that one of the challenges to the index providers is to take the high points from that and be able to assimilate those and work out where the progress is against the frameworks against which they're assessing them. So I think really India is unique. It should find its own path. It can look at other markets and think, well, that might suit our environment, but they really need to find their own way.
Thank you, Tim. But if you're looking at the size of foreign investment in the India government bonds, I mean, in the India fixed income market, which is primarily in India government bonds today, is about 3% on foreign holding, and that's still very low compared to other emerging markets. China is around 10%. Indonesia today, if I'm not mistaken, is about 22%. So maybe Alastair, back over to you now. I mean, what is holding the foreign investor back from investing in India? And we'll come back on the index afterwards, because I think that there's a few points that I would like to discuss there as well.
Thanks, Philip. And I mean, I think it's a very high level. What's holding foreign investors back certainly is a lack of interest or attractiveness from an investment point of view for the Indian market. I mean, if we think about it at a very high level, it's a very large, very liquid bond market. It provides a relatively high yield in the kind of global EM context at the moment. And also, as you mentioned, the very low foreign participation in the market actually makes it a very domestically driven story, which is good from an investment point of view. A lot of our portfolio managers would like the fact that it's driven by domestic factors. It's not necessarily highly correlated to the rest of the EM world, and so as part of a portfolio, it provides a nice diversification factor in that there. It's also got very liquid kind of hedging tools as well available already. We may talk about that later, but what I think is holding foreign investors back still, unfortunately, some of these more market structure, more operational hurdles that still appear in the market in India. I know Miss Bandri and that mentioned some of the developments that they've made, some of the steps forward that have been made in recent months and weeks in order to tackle some of these. But the fact of the matter is that there's still a bit of a bottleneck in terms of how long it takes to get your accounts open in India, the need to provide margin, whether you're buying or selling in that market, timestamps, FPI numbers, they all add to the complexity of dealing in the Indian market. And without it being an index name, to be honest with you, it means that it's very easy as a foreign investor to say, actually, no, I don't want the hassle. I don't need to deal with that at the moment, and leave it at that there. But yeah, as you mentioned, hopefully index inclusion and perhaps euro clearability could solve a lot of these issues and really open the door to foreign investment into India.
Yeah, thank you, Alastair. I mean, you mentioned that the complexity. It's interesting because when we had the training in our training series, we had a day on India, which was an hour training, and what if you have these word blocks that came out at the end of the session, the word that was prominent from the attendees was complexity, and clearly to your point, that is really what is driving probably the biggest impediment today for international investors to really be committed to a market that, to your point, is very attractive, both from a yield point of view, from a macro point of view. But if I'm turning over to you, Badri, I mean, do you have the same feeling or the same sentiment from what you see from your perspective and from your clients?
Yeah, I mean, access issues have always been there in terms of the high paperwork, but though regulations on that have significantly eased over the years. I think there are a couple of other points I want to make, Philip, on this. One is that the non-presence of index means it's an alpha play, right? And therefore, you only get people for the alpha, or you get very long only real money SWFs who participate more regularly. And in that context, if you look at our currency performance, also, we've had the INR move in a pattern which is smooth for a period, and then with a very jerky, sharp moves. And then for investors, therefore, timing of the entry exit becomes extremely crucial to gain, FX adjusted return. So that's been also a little bit of a challenge at times. I think from a country point of view, one of the things that we probably not done well is, the complexity you talked about, to me, doesn't come just from the paperwork needed, but also in terms of the rules around, the whole regime, right? I mean, if you look at it, we've had significant nuanced changes very frequently around tenors, the limits, the tax changes, the withholding. So in a sense, I would say that, at least in the past, when you look back, we probably not looked at it in a very far-reaching way and had a very holistic one-time policy setting, which is very consistent. One of the things that investors always say is that it doesn't matter whether you're withholding taxes high, low, whatever, but as long as there's predictability, there's consistency, it's easy. But if you keep shifting things around, it becomes very complex. So I think some of those are feedback that we've got. But again, like I think Ms. Dimple Bandia also alluded, I think there's a lot of progress, to be honest, that's been made both from SEBI and RBI over the last, couple of years. And I think, that paves the way for things to improve from here on.
Thank you, Badri. And maybe, Tim, back to you now on the index inclusion itself. I mean, typically, because Badri and Alastair were mentioning some of the complexity, the access to market, and so on. So what are the key criteria that an index provider, that FTSE Russell, is really looking at? And where do we stand right now from an India perspective?
Okay. Well, first of all, in case there's any misconception, the basis on certainly which we look at it is about accessibility. I know terms like emerging market, developed market are used in the context of index management, but they are really historic, go back to historic economic perspectives, and that isn't really the perspective which the index providers are looking at it. They are looking at these accessibility issues, and it's the, whether investors can do that in a reasonable manner is really the underlying principles on which we're based. We have a what we believe is a very transparent and objective way of looking at it. We have 17 criteria which are banded in 4 main areas. The way the general market operates and is regulated, how the FX market is structured and operates, how the bond market is structured and operates, and then how the custody, clearing, settlement side work. As a potential accessibility 1 level, which is where we're looking at India at, which would give them access to the emerging market index, they have to fulfill those 17 criteria to a greater or lesser extent. But the focus really for that accessibility 1 level is on, is there sustainable primary issuance? Is the process for foreign investors registration reasonable and not overly complex? And then it comes down to, is there sufficient liquidity in the secondary market? How many people participate in it? And of course, as index providers, we need to be able to calculate an index. So does the pricing support the ability to actually create an index? And then finally, on the settlement side, you've got issues like DVP. But the other things that have been touched on that do come into that are accessibility to foreign exchange. Obviously, that varies, and you get different perspectives from the Asian community or who are in the same time zone to, say, the US community who are dealing with it out of market hours. You have to take those into account in terms of how you think about some of this stuff. And tax is definitely one of those things that has been an impediment, I think, historically. But there are ways of solving this. Markets can solve them by their direct regulation, or they can participate in a global platform that makes some of these things easier. So there isn't one solution to these, and I know India is certainly working very hard on some of these things. And part of the reason they're on our watch list is because it's evident that there's a commitment to actually make change and improve. So we're recognizing that.
Thank you, Tim. So yes, indeed. I mean, a lot of improvement, a lot of ground that has been worked through, and I'm turning over to Bala now. Clearly, I mean, as you said, ground has been set, but there's still some of the gaps and pain points to address. Can you just provide us a little bit what are these points that needs to be addressed, and what is what we're currently working on as we speak?
Yeah, thanks, Philip. As you're aware, foreign investors coming via the FPI route are largely banks investing in the government bond market, T-bills and the dated securities. So in terms of tax and regulations, what we have is an exemption for dated securities, that carry regular coupons, provided they're traded on an ICSD platform. So therefore, to the extent people are interested in other securities, that is something that we need to consider. Now, while there are, again, in the tax law, beneficial tax rates provided in the context of sovereign bonds, what we don't have is a beneficial or an incentive regime or an on-par regime even provided for benchmark securities that are issued under the FAR, which are likely to be traded under the ICSD route. So that is going to be quite key. And as part of this budget FY22, what we're likely to see in February, or what the industry is anticipating in February, are tax-related changes that are going to give effect to some of these policy requests. The industry has requested that the coupon withholding tax rates on these government bonds be on par with FPIs. Because if someone were to come under the FPI route and they had access to a 5% withholding tax rate, why should there be a differential withholding tax rate when, especially a very high one, currently when they're coming under the ICSD route? Because that would clearly, sort of hold people back from looking at this market quite seriously from an index inclusion perspective. So I think that is something that we need to bear in mind. And also certain tax clarifications that are needed in terms of saying, okay, so currently what is exempt is capital gains, and how do we get there for someone who's frequently trading is, again, something that has been requested. And hopefully that is also clarified to give us that certainty that okay, so we said that this is exempt, and therefore, there would be no tax associated, depending, irrespective of however somebody is trading or holding long term. So I think these are some of the key changes that people are looking out for. And the other thing that is, in the context of these bonds, has also been requested is a parity on tax rates with different asset classes. Now, I don't want to go into a lot of detail. There's a separate discussion on that scheduled for later. But at a high level, if capital gains were to be taxed at 30%, then again, that is a significant high rate. So, in terms of the broader market on government bonds, if there is a view on, sort of giving similar taxation rates to, say, equities, which currently carry 10 or 15% for, say, domestic investors, then if there is a consideration for that, that again would be a great benefit in the overall scheme of things to enable more people come into the government bond market and deepen the liquidity in that. So I think that those are some of the sort of high level themes you're looking at from a tax policy perspective, and to the point that Tim alluded to, that there has to be accessibility, and the process needs to be fairly simple and not onerous. I think on that front, I think if there is an easy to implement tax process that's sort of given in the Indian context, I think that would be highly appreciated by the industry as well.
Yeah, thank you, Bala. And I think it's a very good point. And we've seen in other jurisdictions that, and also to Badri's point earlier, is that if you don't have that clarity or the predictability in terms of tax treatment, for example, on government bonds, that is really deterring the investor to go in. And I mean, if you're looking at Korea, for example, is a good example where some of the back and forth on how the tax treatment has gone for foreign investors into the market as not being helping the access to the market for investors. We were talking earlier around liquidity of the market. Ms. Bandia earlier in her presentation mentioned hedging, the improvement of the hedging and the funding access for FPIs. And it's clear that a liquid, transparent, and deep capital market and fixed income market requires an active funding and a hedging market. And maybe Badri, over to you now. I mean, do you see that from an India perspective? Is it the case? Do we have actually a liquid and deep and active funding and hedging market? And do FPIs have the right tools and access to these tools when dealing with India? And I'll go to Alastair afterwards to hear his view from an investor point of view. But Badri, over to you now.
Yeah, sure, Philip. I think India has always had a fairly deep OIS market over the years. Participation historically was limited to foreign banks, largely leading to, and that led to exaggerated movements, but there has been significant widening of the breadth of the market in recent years, with many private banks running large books. And importantly, regulatory changes recently, and Ms. Bandia talked extensively about them, so I may not want to repeat them. But essentially, I think they have those reforms or changes have enabled new products and solutions to take off. And importantly, RBI has also shifted from a prescriptive to a principle-based regime, right? And that provides scope for a lot of customized hedging solutions to pick up. Interest rate options have also rolled out a couple of months back, and we expect the volumes to pick up next year. So I think the local hedging market, derivative market, I think is reasonably broad and deep. From an FPI point of view, RBI has opened access to non-residents, and it's not just FPIs. Actually, a couple of years back, RBI actually opened it up to all non-residents to come and participate in the onshore derivative market without any restrictions. So that means, investors today can choose to hedge onshore or offshore wherever they get better liquidity. Of course, some further clarity is needed on some of the tax aspects around it to, increase volumes. But in terms of access on the hedging side, I think it's already there. Funding, while the local funding market is very deep, in fact, it's very, very large, but that's, I don't think, available as such to, you know, the FPIs. And to be, I think that's a conscious decision. And personally, I don't think it's such a big imperative, you know, to get that for FPIs at this point in time. The FX market, though, which is another important way for them to look at from a settlement and so on. Again, you know, that's quite deep, vibrant, and also it's shifted to a 24/5 market. So again, you know, that is another piece which is available for foreigners to easily access, and that's quite deep.
Alastair, any views on that and the previous point that were mentioned?
No, I mean, I think Badri's absolutely right. In terms of a foreign investor looking at the Indian fixed income market, it certainly compares very favorably to other EM markets in terms of the hedging tools, you know, available to us. Whether it's the NDF market to hedge our, you know, our FX exposure, we can pretty much trade that 24 hours a day. New York hours is not a problem, and also the offshore, you know, swap market as well is available to us to hedge our duration exposure in India. So it does compare very favorably. And then I would just go back and re-highlight as well, though, unfortunately, due to the complexity around things like, you know, the tax implications of using these tools, again, they probably haven't been as used as much as they are able to be from the foreign investors' point of view. So yeah, certainly lack of liquidity or access to hedging tools is not one of the issues that we worry about when we look at India as an investment opportunity.
There's more of a tax treatment of these instruments. That's probably it.
Exactly. It's amazing the ripple effects that the tax issues have throughout the whole system. And that, as you say, you know, we often struggle sometimes to get a quick turnaround in our, let's say, post-tax settlement amounts for trades, and that means that then we have to delay our hedging flows. It means we have to delay our repatriation flows. So it has this domino effect, unfortunately, from the uncertainty around the tax issues in India.
Well, I mean, Bala, any comment on that? I mean, of course, there will be tomorrow a panel on tax. So, I mean, of course, we don't want to delve too much into that, but maybe a quick reaction to Alastair's comment on the tax regime there for hedging tools and funding tools.
Yeah, I think on the tax front, you know, it's long been asked that the FX taxation be rationalized by the government so that, you know, you don't treat two different situations differently. Where the FX is honored, there is really no taxation, but when there are different kind of rollovers and other provisions or other sort of settlements, then there is a tax impact which impacts settlement and the timelines. So clearly there is an element of being a little bit more open about that. The other advantage that potentially foreign investors could look at is dealing with IFSC banking units. You know, it's going to be covered in a different session where there are certain tax exemptions provided. You don't necessarily need to go through the same processes as you would go through hedging in Mumbai. So I'd just probably leave it at that. But at a very high level, and India being an FX controlled market, FX controls act as a last point of control from a tax perspective to ensure that you know, due taxes are paid before you know, foreign investors take their money out. Now that convertibility and the point in time we get there is probably a little far away, at least in the medium term. But you know, certainly there is, you know, the move towards T+1 and earlier settlements would sort of you know, help in certain clearances happening a little bit more faster. But of course, that it creates other challenges in the market. So I'll just pause there, and you know, happy to take any questions later.
Yeah, thank you, Bala. I mean, just looking at the Q&A section, just a reminder for people, don't hesitate to put your questions into the Q&A box on the right-hand side of your browser. We have two questions here. One that I will keep it for the next part of our discussion. The first one is, are the bonds accessed via the ICSD route different than the one from the FPI route? And if yes, of course, that would create a dislocated market. Maybe I think Bala, I think that you can answer that one.
Sure. So under the regulations that have been issued in March 2020, there are two routes which have been created. So for those coming under the FPI route, you obviously have access to the FAR securities, but as long as you're registered as an FPI, you can't really access the ICSD route. But if you have a different vehicle within the group and there are multiple funds, then potentially we could look at the other funds which are not registered as FPIs accessing the ICSD route. So in terms of onboarding, I think those are some of the checks and balances which might be imposed by the ICSDs for people who wish to come onto this particular platform. So it would be, so if you're an FPI, you're registered in Mumbai, and then you can't register offshore.
Yeah, but the bonds that if an investor who's going through the FR to the FAR or through the FPI can access to the same government bonds, or the set is different. I think the set. I think the FR route, if I'm not mistaken, is a subset of what the FPI can have access to.
That's right. So I think what will happen, and this will go back to the mechanics of the settlement process that will likely be established. But if the platform operates on its independent capacity, and we have people participating in the platform who can trade within themselves, and then there are ways and means in which the bonds can be traded outside the platform. Then when the bonds come outside the platform, then I think there would be an ability for FPIs to participate in the FAR securities. So it is not necessarily one way. So bonds which are meant for ICSDs technically may not just stay there. It could potentially be traded by domestic and other participants as well. Okay. But the settlement process and the details will tell us how effectively and quickly that can be done.
Thank you, Bala, and I hope that answered the questions of the person in the audience. So let's shift gear now and look into, let's say we are now the Indian government bond are included in the index, or that it's processing into the inclusion. So what are the consequential benefits from that? And one of the questions, of course, that was asked here, and I'll come back on that one later, is really the benefit from an Indian government point of view and the credit spread itself. But maybe over to you, Tim. What are the consequential benefits that one could see from on the domestic market in terms of volumes, investor types, and the like, once the index inclusion is either confirmed or effected?
There are obviously a number of ways of answering that question. I think obviously from a government perspective, in terms of the issuance of new bonds, you would see that they have a broader pool of participants who may have an appetite to participate, and therefore it may enable higher levels of issuance to actually occur. But if we turn back to more the accessibility type of routes, obviously one of the challenges we always have is around liquidity. Liquidity is a bit chicken and egg. Yes, if you're included in the index, then there's naturally going to be more people looking for liquidity, but there has to be an established or a belief that there's sufficient liquidity in the market to make that decision. But once it is made, obviously you have got more participants, you have got probably better price discovery and price formation happening within the marketplace. You've probably got a benchmark yield curve and an established overall credit curve that is useful, that can actually empower the corporate market. It might enable the development of a more robust and vibrant corporate market on the back of that. So I think there are a number of things beyond that. Obviously, there are just being on the radar of index inclusion means that, the trend is very much around things like thematic indices and things of that nature, whether they be climate related, ESG related, or more custom based. India, as part of that larger opportunity set, would get potentially included in those type of thoughts and conversations as well.
Thank you, Tim. And so what can be expected with Badri? What can be expected for India? And one of the questions from the audience was, do you think index inclusion will reduce the cost of borrowing from the Indian government in the long term, considering there would be more demand for Indian government bonds? Badri?
I guess not just long term. I think the expectation would be that it reduces the cost of borrowing in the short term as well. Look, I mean, like Tim just mentioned, right? I mean, you just open up your bond, auctions and bond supply to a whole host of global investors, and there are a lot of passive, investors, passive funds, which are, I mean, one of the biggest themes globally is the expansion of the whole passive investing theme. Especially into the fixed income space as well. So definitely there would be a strong expectation, and also I think it would happen that way, that the strong demand and appetite would necessarily result in some borrowing cost reduction for the government. I think beyond that, from a domestic market point of view, if you look at it, the demand supply gap which is there in the bond market today, right, would substantially change with consequent impact on yield movements and also better liquidity. This will also lead to better investment portfolio management for local banks, right, especially around the AFS and HTM books, which sometimes get complicated due to most bonds being off the runs and so on. Today, if you look at the market, right, there are very few on the run bonds. Many bonds become off the run the moment the government stops issuing them in the auction. And with greater participation from a whole host of new investors, I do believe that there would be more number of on the run bonds, and the liquidity even for off the runs would substantially improve, and that's significantly better from a domestic investors point of view as well. Third, I think as investors globally invest in Indian sovereign bonds and become familiar with tracking the Indian markets, etc., I also feel that it would hopefully, maybe I'm hoping a little bit here, but I think consequentially you will see more Indian investor interest in corporate bonds markets as well, because that would be actually an excellent development as and when it occurs, because that's really the benefit of making a lot more of investors come to India. They could start with sovereign, but once you're there, you're tracking, you become more familiar, that would just, as a next step, consequently expand their portfolio. And lastly, I think the index inclusion would just be simply a big step of integration of the Indian financial markets to the global markets. Now, it comes with certain policy risk, of course, especially in terms of whether our policy making could become hostage to some global expectations and so on. But the way I see it is, as a country with clear aspiration and goal to march towards a 5 trillion economy, I think we should move towards this with confidence and belief that we will always do the right things for the country, and more importantly, we'll be able to explain and present our actions and policies to the world at all times. So all in all, I think there would be a substantial second round benefits to the domestic fixed income markets in general.
Yeah, thank you, Badri. And I think the point you mentioned on the corporate bond market is absolutely critical. And we've seen indeed that a strong and liquid government bond market is usually the start, as Tim mentioned, to really provide the base for the corporate bond market to develop, but also to start that move from loan financing to bond financing. But if I'm going back to you, Alastair, we mentioned earlier, we've asked you earlier, I mean, why there was not much of appetite today or what was holding the investor back. Clearly, what would then an index inclusion change in the view from the investor community into the on the India capital market and the government bond especially?
Yeah, it's a great question. I think the long and short of it is really it means that we can no longer ignore India as an investment opportunity in fixed income. I mean, it would act, as we've talked about, as a magnet to pull foreign funds in the initial stage. But I also think that magnetic effect means that the money is more likely to stay in the Indian market, and that is well. I mean, the reality is with India not being an index name for us is that we can, if we have a less favorable view on the outlook for the Indian market, is we can sell all our holdings and take our money out, and that's the way we reduce our risk. But as soon as you get index inclusion, that equation actually flips itself on its head, and now the potential thought to sell Indian assets and take our money out actually becomes a risk adding decision to our portfolio and the way that it would then affect our tracking it or our ability to match the benchmark in that there. So as I say, I think what index inclusion does is just raise that hurdle rate for foreign investors that, when things perhaps don't look particularly rosy, in terms of the outlook for bond yields, is it makes it harder to then say, that's it, I'm going to sell and come out in this market and that there. And I think, that magnet effect, obviously, regardless of which index or range of indices, India potentially gets included in, has some beneficial effect. But I think the real key, step forward would be if we could get India into some of the more developed market indices effectively, because again, I think the reality is like active investors, active emerging market investors like myself, probably have already done the legwork to get some sort of access route open for our funds, certainly our emerging market funds, into the Indian market. But then as soon as you put it in a developed market index, you've just really broadened out the range and also the scale of funds that now have to look at India as an active investment decision as well. And as has been already pointed out, with the amount of passive money that now follows the more developed market indexes, traditionally, it means that India could enjoy the fact that regardless of the outlook for interest rates, that passive money has to stay in the country and follow its bond market there. So it's a very healthy, a very positive thing, I think, for India to be able to achieve that. And I would definitely echo as well some of the previous comments about the ripple effects that the inclusion of just the bond market to begin with, the government bond market to begin with, would have. I mean, as an active investor, we're always looking to outperform our benchmarks. So as soon as government bonds are in there, we're always looking at the next derivative. Perhaps it's state development loans, the quasi type governmental names. And then once those are exhausted or included indexed, then the next step is quite naturally to start looking at the corporate bond market as well, which we know India already has a very large and developed market there to offer.
Thank you, Alastair. I mean, looking at the clock here, I mean, I've been told that we probably have 3 or 4 minutes left. I think we could go on probably for another half an hour on that, and so I still have a number of questions that we haven't gone through. So maybe as what I would say, probably what I would ask probably now is probably to have your last thoughts on that. Probably from a team perspective, clearly and quickly, a minute or two each. The bond index execution is only a first step. So where do you see it going from there? And probably for Alastair, Bala, and Badri, I mean, what from your point of view definitely needs to be done both from a regulatory or from a markets point of view to win the game? So maybe your last thought before we're closing the panel. Maybe Tim, starting with you.
No, thank you. So, I mean, it's in some ways it's keep up the good work. I mean, the reality is, as Alastair says, as you progress in terms of index inclusion, then there is, higher scrutiny placed on all aspects of the landscape. I mean, the key ones, though, in terms of making more inclusion, are things like ensuring a level playing field between local and foreigners, looking to global best practice in terms of how the market operates, particularly, as has been said, be consistent in the approach to regulation and taxation. A lot of decisions are made on the back of those. There's a desire for more openness within the market so people can make proper assessment of that type of thing, and dissemination of information. Make sure that that there's adequate information out there for people to make their appropriate investment decisions, and it's not just about legislation. It is about ensuring the practical experience is what is enhanced, not just about passing legislation. So follow through a market what you're doing.
Bala, from your perspective, your last words.
So we keep hearing that India is a large and complex market, but as we've seen with some of these changes, we've been able to bring synchronized changes or been able to engage with the authorities to bring about some of these changes to the market for the broader development. So I think in that spirit, and as we've spoken about the corporate bond development, I think time is right for us to sort of put in a regulatory framework or a roadmap to say, okay, this is how the corporate bond market development ought to take place over the next few years, or at least that this is the vision. So if you have a vision statement, I think that's a good place for us to start. And then, whatever are the, ancillary tax or regulatory changes, such as, increasing the VRR limits, if those are today in short supply, I think those would be clearly measures that we need to take to encourage more further foreign participation immediately off the back of this, and we can substantially increase the limits thereafter if there's further demand. So clearly, taxation, as has been alluded to in this, discussion, plays an important part for foreign investors to decide what is their post-tax return. So clearly, the ability to sort of have a reasonable tax rate that foreign investors are happy to pay in India would be sort of, important milestone for us to achieve. And I'd probably, there are a few other points, but I think these are the key ones for now.
Thank you. Alastair, and then I'll hand over to Badri afterwards for closing.
Yeah,
Alastair?
Yeah, I mean, in summary, I think India as a fixed income investor is just still a very exciting opportunity. It's the last big market probably globally now that's not included in any of the indices. So as I said, being a fixed income investor in the region here, it's a great opportunity, looking forward. I think if you look slightly further east of what China has been able to achieve over the last 4 or 5 years in terms of opening up its bond market, the way it's attracted foreign investors, the way it's been able to keep foreign investors in that as well. I think we could see something hopefully similar with India if we can just get over some of these little hurdles that still remain in the way in that there. And I think as well as probably similar to what we're seeing in China as well, as Indian market opens up and onshore regulators, onshore government bodies get comfortable with how foreign investors are acting in the market, how that money is attracted, how sticky that money is. And I would hope to see the gradual rollback of a lot of the rules and regulations, let's call them, around the Indian market to really free it up.
Thank you, Alastair. Badri, your final comments?
Yeah, look, Philip, I mean, I think it's long overdue, right? This whole index inclusion. We as a country actually have played the leverage the different way. We've allowed the equities to be owned by foreigners over the years while we tried to keep the leverage down to the domestic, savings. And that's put a lot of pressure around, capital cost and so on, crowding out over the years. I think this is with all the transformation and the general macro positive environment in India at this point in time, and the global interest, I think it's more than overdue that we get into this and complete this task. A lot of steps have been taken, by various regulators, the government, actually over many years now to get to this point. And what I would just simply say is that we just need to now take the final, few steps and ensure that, we get there much sooner than later. So, we should just look forward to this.
And make sure the sun never sets on the Indian government bond market.
Okay. Exactly.
So on that, gentlemen, thank you very much for your time, which I thought an insightful full panel. And I'll then introducing the next panel for the rest of the day. Thank you very much for your time.